Hello, everyone. This is Phil Yaeger of CPA Review and More. Why do we call it CPA Review and More? Well, the whole intention originally was to talk about preparing for the CPA exam. And then we realized, how much can you say about the CPA exam? So we added the term and more. And we end up talking about things really other than the CPA exam, all right, as we are going to be talking tonight to a terrific guest. But before we start that, let me mention this to you. The one thing I do on every podcast is this. I'm sure you all know by now that my wife is a Parkinson's patient, 6 years, and I try to raise money the best I can. And I'm going to ask you if you would do this for me. All right. Send in whatever you can send in, all right, to the Michael J. Fox Parkinsons Foundation. All right. They'll take $1, $5, whatever you can send in. All right. Just go online and look for Michael J. Fox Parkinsons. All right. They are coming out with new medications. All right. Very aggressive. And as you know, Michael J. Fox, who was in Back to the Future, he actually got Parkinson's when he was quite young. All right. But he is the key figure in that organization. And without him, I don't think Parkinson's, as far as cures, would be moving as fast. So please do that. And I just want to tell you, this is our first really podcast of the new year. So I want to wish everyone out there a happy, healthy new year. And of course, we have this wonderful virus that we can't get rid of. All right. So stay healthy. All right. And stay, do me a favor. Whether you believe it or not. All right. I believe to go get vaccinated. All right. Think of the other people. All right. Now, of course, there's a big controversy. I don't believe in that. But, I just remember one thing growing up. We had polio to deal with. No one, when they came out with the vaccine, said, I don't want to get the vaccine, blah, blah, blah. Just about everyone got vaccinated. Now, polio is not gone, but I don't think we've had a case of it in a long, long time. So please consider that, okay? And without further ado, all right, let's go to our guest, all right, who actually has a home right on the water. In what island is that, Steve?
The island of San Francisco.
The island, San Francisco now has palm trees, all right on the streets. Is that on the streets or is that in Alcatraz Island? Where is that?
No, well, Alcatraz is the place where people with bad lawyers went. That's my living room in San Francisco with a nice Zoom background.
And by the way, it looks awfully good. We used to go on cruises once a year. But since this COVID thing, no way, I'm not stepping onto a cruise ship until they guarantee me that I won't get sick. But, I used to get sick a lot on cruise ships. It's like a breeding ground for people who have all these diseases. So anyway, but we do miss those annual cruises. Steve is a senior partner. How many senior partners are there, Steve?
I'm the only senior partner.
He's the only senior partner at the law offices of Steve Moskowitz, LLP. By the way, you have any relatives in New York that you know of?
Although I moved to San Francisco from New York City, no.
Okay,
no
but I'm saying still.
Oh, no.
All right, because I have a friend of mine who is a disc jockey in New York City, and his name is Cousin Brucey. And
I remember Cousin Brucey.
Remember Cousin Brucey? Well, Bruce, his real name, all right, is Bruce Moskowitz. Moskowitz, all right? But he changed it to Morrow. And I haven't seen him in a few years because he used to occasionally invite us to the studio at Sirius XM. Now he's back on his original station, which has nothing to do with accounting, by the way, or tax. He's on WABC radio. And if you like 60s music, 50s, some 70s, all right, he's on every Saturday night streaming WABC radio. I get excited when I hear WABC. That was the station I used to listen to when I was growing up. All right. Anyway, Steve is a tax attorney. Am I correct, Steve?
Absolutely.
And Steve is a graduate. He went to Golden Gate University School of Law, which is obviously in San Francisco. All right. And then after you got that, Steve, all right, correct me if I'm wrong, you went on for your Master's of Law.
So
In
what happened was
taxation.
I got my bachelor's degree in accounting from Drexel University in Philadelphia.
Okay.
Then I went to New York University and got my MBA in accounting. Then I became a CPA. Then I went to New York Law School and I got my Juris Doctor, JD law degree. And then when I came to San Francisco, I got my advanced law degree, LLM, specialization in tax here in San Francisco.
Now, Steve, can I assume you're not going on for any more education right now?
The education that I get now is for my benefit and the client's benefit, but I've had enough formal degrees.
Okay, so you're not going to go on for a medical degree or anything like that?
Not at the moment, no.
Well, you know what they say, there's plenty of time, plenty of
Plenty
time,
of time.
plenty of time. Because Steve is only, we were discussing age, 35 years old, and God bless him, he looks damn good, doesn't he? All right.
Well, you know, I've done a lot of stuff, and as one of my colleagues in the office said, that they give me my annual celebration of my 35th birthday.
So Steve, based on, well, I'm not going to guess your age. It's just, no, it's always, most people can't guess my age, okay? I actually just turned 102.
I was going to say 27.
Steve, you're okay. God, you know what? You're going to get an extra 10 minutes
All right.
on the podcast. Now, Steve, tell us what you do at your law firm. All right. You deal with small businesses. What do you do? What type of tax?
We deal with a lot of small businesses. And the reason that I went to law school was to do tax planning. Because when I set foot into law school, I already had a bachelor's and master's degree in accounting. I was already a CPA practicing in tax. But I looked at the Fortune 500, the companies making billions of dollars in profits. And every year you see them in the newspaper, they legally don't pay any taxes. And I said, well, the law isn't just for Fortune 500, it's for everybody, but it's so complex and intricate and it's hidden in there and you have to know where it is. It's like a hidden treasure. So I went to law school because I wanted to be the guy who tell the clients what you can do, not what you can't do. I wanted to show them how to legally save money. And something that I'll oftentimes do with a new client, I'll say, so, do you think you make more or less than Apple Computer? And they'll all laugh, ha ha, well, I make less than Apple Computer. But I say, yeah, I believe that. But you know what? You pay more taxes than they do. Why is that? Because the Apple Computer has an army of people like me saying, do this, do this, do this, do this. And most small businesses, the owners work really hard. And they wind up, when they come home at night, their biggest decision then is, should I get something to eat or just go right to bed? And they, you know, like the old joke with the shoemaker doesn't have shoes, they go ahead and then another term I have is then they have what I call March Madness. And I'm not talking about college basketball. I'm talking about, they say, oh, you know, I'm paying so much taxes. There must be something that can be done. And then they get busy again and they forget about it until next year. So what I do is I say tax planning is a year-round deal. And a tax return should merely be the summarization of a year's worth of planning. And there's so much you can do. So right now, as you introduce the show, here it is. And it's the beginning of 2022. And somebody could be listening to this, a business owner, and saying, oh no, I wish I had heard Steve in December, because so much of tax planning has to be done on or before December. You have to write the check by December 31st of year one to deduct it in year one. And if you write the check in year two, you have to wait till year two to deduct it. And that's true with a lot of stuff, but not everything. For example, one of my favorites, pensions. There's over 20 different types of pensions. And with a lot of them, you can set it up and fund it 3/4 of the way into year two and still deduct it from year one. So I'll say to clients, look, and I don't just confine myself to the tax aspects. I'll explain the other things. And there's 4 major benefits of pensions. Benefit 1, you pay less taxes. At that point, most people say, sign me up, Steve. I say, well, okay, good. But there's more things. Benefit 2, your earnings are not taxed while it remains in the pension. So what that means is that your fund grows faster and bigger. And I'm using in terms pensions and retirement accounts interchangeably. There's some little differences, but we don't have to bother ourselves with them here. Benefit 3, cash flow. You don't have to write that check by December 31st. Year 1. You have about, depending on the type of plan you have about 3/4 of the next year to write the check or even start the plan and still deduct it from year 1. And benefit 4 is asset protection. The money is safe. So suppose you get sued. And, today everybody loves to sue everybody else. It could be an automobile accident, all kinds of things in business. And I say, you know what? You looked at me the wrong way. How dare you? I'm suing you. And the jury says, well, that's right. You looked at him the wrong way. You shouldn't have done that. $1 zillion. If you suffer a judgment in excess of your insurance, the plaintiff can't touch your pension. I hate to mention his name, witness O.J. Simpson. And even if, look at O.J. He's had a judgment for many millions of dollars against him for a long time, not lost a penny of his pension. And even if everything goes really badly for you and you have to do a bankruptcy, you keep 100% of your pension. So it's very, very powerful. Not to mention, I say to clients, well, which would you prefer? To have a big stack of canceled checks payable to the IRS, or a big fat bank account or stock account or other investment account that's your pension because you wrote such smaller checks to the IRS and your state taxing authority, if you're in a state that taxes, which most of them do. So the bottom line is it's just so beneficial. And that's just one of the things that we talk about. What else can we do after the end of the year? As pensions it? No. When we take a new client, first thing we look at is, does this client qualify for R&D? Well, it's R&D, research and development. So basically what happens, and one of the things I like about R&D is, unlike most other things where, the tax guy says, okay, now look, invest X number of dollars, but it'll save you Y number of dollars in taxes, which is good. But with R&D, you're not spending a new penny. What we're doing, or if you come in or who's ever doing this, is you say, okay, I'm going to take a look at your spending this year and the previous 3 years, because you can amend the returns. And I want to see how you spent your money. And if you spent it a certain way, then what we can do is say, okay, you get a tax credit. And as you know, but I just point out to your listeners, a credit is far more valuable than a deduction. If you have $100 tax deduction and you're in the 30% tax bracket, you save $30 in taxes. If you have a $100 tax credit, you save $100 in taxes. This is a credit, dollar for dollar. So this is a tremendous benefit. And when I stress, you already spent the money. You're not spending a new dollar, but we're saying, okay, I can classify this as R&D, and you get this big check from the government. Now, why should there, we talked about pensions, we talked about R&D, there's lots of other stuff, there's all kinds of credits and all kinds of deals. Why in the world should there be such a thing? How can that be legal? So we have to take a look at the tax law itself. There's two purposes to the tax law. Everybody knows about the first one, extracting money from us. Everybody knows that one. But the second one is a different purpose. The government would like us to do certain things because it's good for the economy. But in a democracy, the government can't order you to do something. Like they can't say to a businessman, it's good for the economy, buy a new machine or buy a new building or do this or do that. So they say, well, okay, we can't order you to do it. So they give you an incentive. What's an incentive? Well, if you do this, what we want you to do, like buy the new machine, buy a new building, whatever, you pay less in taxes. And that really does incentivize a lot of people. And that's essentially the gist of how the Fortune 500 can make billions and not pay any taxes, because they're doing something that the government has deemed socially useful. The government wants them to do it. And they say, okay, well, you know what? If you do this, you can save taxes up to ultimately not pay any at all. That is why you have these things. And what happens is these things are available to everybody. But it's kind of, think about it like this. Suppose I said, you know what? I have a magic business card here. and I'm going to hand you the magic business card. And if you walk down to the IRS office, they'll write you a check for $1 million in exchange for the magic business card. You'd probably walk right down to your local office and get your $1 million. But suppose I said, okay, I'm going to take the magic business card and I'm going to put it in the back of a dump truck, big dump truck. And then I'm going to take all other kinds of business cards and I'm going to get in the back of the dump truck with a big shovel and I'm going to mix them all up. And I'm going to back up to your office and I'm going to dump all the business cards in your office. Now you come in the next day, your office is filled with 1 million business cards. What would you do? You'd probably say, oh my God, what's going on here? Was there a vandal? Was it an accident? Look at all this clutter in my office. I got to hire somebody to clean this up and hold it all away. Well, guess what? You threw away your $1 million magic business card because you didn't know it was there. To you, it was just a bunch of junk. The Fortune 500 has a bunch of guys like me say, I know a magic business card is in there and I know where it's hidden. That is what tax planning is. That's what this is all about, is knowing where that magic business card is. And there's just so many things, I could go on and on and on, but you see benefit after benefit after benefit. And that is essentially why I became an attorney. I didn't want to chase ambulances. I didn't want to do divorces. I didn't want to get bank robbers off. What I wanted to do was save people taxes. And then if the government challenges that, okay, here's why we've done what we've done. And it's okay. It's really okay. And, I've been on the radio for 30 years as a radio commentator. And I've been on TV 17 years as a commentator, 7 years Fox, 10 years NBC. And I talk about this stuff all the time on air. This, if an example I use is twin brothers that are alike in all respects, except one brother pays attention to his taxes because he hires the right person to do these things for him. And the other brother also works very hard, but he just files his tax return every year. When the two brothers retire, one brother has a big fat bank account and the other brother has a big stack of canceled checks to the IRS. This is what it's all about. It's so vitally important. And again, the government gives us these things. There's so much. And then, for example, another thing, a lot of people own property as part of their business or they're landlords. So one of the things is that we do is something called cost segregation analysis. So we know if we're writing off a building, we write it off over either 39 years or 27 and a half. But that's a long time to wait for a benefit. So what cost segregation analysis does, we send an engineer to your property and he or she says, well, okay, this is 27 and a half or 39-year property, but this part's 15-year property and this part's 10-year property and this part's 5-year property and this part you can write off all in the year, and it greatly accelerates depreciation, time value of money. That's how banks make their money, time value of money. So what happens is if you have a benefit today instead of 39 years from today, you could save those taxes, and instead of writing that check to the IRS, you can invest that money. And now you have a big fund of earnings that wouldn't have existed if you wrote that check. Cost segregation analysis. That's one of the many things that we do. And then we say, okay, when somebody gives you something nice, what do you say?
Thank you.
Except a lawyer. A lawyer says more. I want more. So let's assume we have this situation. We have a woman that's a brain surgeon, and she's married to a house husband. And she makes $1 million. She has a building that takes in $10 million in rents, and she has to write checks for $9 million. So we have, to me, one of the most beautiful things in the English language. Very, very nice. A positive cash flow with a tax loss. So we say, well, all right, physically, she's now made $1 million in profit from this building. Now, depreciation, you don't write a check to depreciation. It's a paper entry. It's theoretical. And let's assume she's done cost seg. And we say, okay, with cost seg, she has a loss of $500,000. Now, again, physically, her bank account is $1 million more on December 31st than it was on January 1st. But through accelerated depreciation, now she has a loss of $500,000. And coincidentally, keep the math simple, being a brain surgeon, she made a profit in her practice of $500,000. Can she write off that loss from the building against her profit or wages or dividends or interest? So we take a look at Internal Revenue Code section 469. The general rule, which most accountants will type is, oh no, well, that's a passive loss and no write-off for you. But remember her beloved house husband, she says, honey, off the sofa, you've had enough bonbons, you can tape Oprah, you are going to manage my property. And the husband qualifies to be a real estate professional, and it doesn't take much to qualify. Now that's the exception to 469. So it's no longer a passive loss. It's an active loss. And now that $500,000 paper loss from the building, we apply against her earnings. And let's take a look at the good doctor here. She's made really a profit of $1 million from the building and $500,000 from the medical practice. She's made a profit of $1.5 million, but she legally doesn't pay a penny of income taxes because she utilized cost seg, and then she coupled the cost seg with, what did she couple it with? She went ahead and she coupled it with making the husband a real estate professional. And then, these things can go together. Well, wait a minute. What if she had a pension? That would give her even a bigger deduction. And maybe she can offset that against another year. Another thing that happens with these pensions, we do planning. Suppose we have this situation. We have somebody that makes, and this happens in business, sometimes you have an unusually good or bad year. An example of this would be lawyers that deal with plane crashes. They have a year when they make beaucoup, and then they have a long time and they don't make anything. But let's assume that we have that in the business. You had an unusually good year. With these pensions, they're so flexible that you can make multiple plan year contributions in one calendar year, which means you can get a beaucoup deduction in that year when you had all the extra income and avoid paying the taxes legally. Or if you had a bad year, you can do the reverse. So that's why we come in and we do the pension planning. Then we say, well, all right, what about other things? So we do estate planning as well. So right now, most people don't have to worry about the estate plan because with the exemption being what it is, most people have far less than that. But if you do have more than that, or the government is always looking at that exemption, always saying, there's always a lot of Congress people saying, you know what, that's too much, that's too much, that's too much. And there's been a lot of talk, especially recently, about bringing that way down, where a lot of people would be subject to estate taxes. How do we beat that? Well, let's take a look at tax planning. Suppose we have this situation. John and Mary are married, and it's their wish to live in their home for the rest of their lives. And when the second of them passes, the home would go to the charity of their choice. That's nice, but there's no income tax benefit in that. So instead, what we would do, we'd set up a CRT, charitable remainder trust. And what happens now is everything is the same physically. John and Mary live in that house for the rest of their lives. If they live to be 300 years old, they stay there 300 years. But whenever they pass, the charity gets the house. An actuary comes in the year they say, whenever I die, many years whenever the second spouse dies, many years in the future, we're going to do this. The actuaries, let's make up some numbers. Let's say they had $1 million equity. And let's say the actuary says, well, based on your ages, what you gave away, it's all theoretical. What you gave away was worth 800 and what you kept was worth 200. John and Mary get an $800,000 tax deduction in year one. And that's wonderful. Except what if they don't make $800,000? They can carry it forward. So the bottom line is physically, everything is the same. They live in the house the rest of their lives. But the charity gets the house when the second one passes. But they get an income tax deduction now. They can live better now because they have more money because they pay less taxes. A lot of other things too. Suppose we have this situation. John and, well, we'll have another. Sally and Bob bought a house 40 years ago and they had a few kids. Now the kids are grown. They're rattling around in the house and they say, you know, boy, we bought this house 40 years ago for a song. It's worth millions today. And that's not hard with houses today. And they say, you know, we'd like to move out of this house and get into a nice small condo in someplace warm and nice. But I don't want to pay 7 figures in capital gains, or any amount of capital gains. My God, what can I do? Well, another thing you can do is say, well, you know what? I can exempt part of the sale, but the other part that I can't, how about if I gave that to a charity and then you negotiate with the charity and they can pay you a stream of income for the rest of your life, much like an annuity. So you can choose to either get a set amount for the rest of your life monthly, or you say, I'll take a percentage of the portfolio. So if the portfolio goes up, you get more. So what happens now? Well, you get a tax deduction for the portion you gave away. But what happens is this. You say, well, I could sell the house and buy the stock, but you'd have all those capital gains taxes. The charity doesn't have to pay taxes. So they invest a larger amount, which means your stream of income is a larger amount. And, I could take up your whole show with cute little things like this. But what I want your listeners to know is that these things go on.
Okay, we're going to go back 1 second because we froze for a second. All right. And you were talking about, all right, the charity. Let's go back. All right. You give some of the residents or whatever to a charity. Can you go back to that point?
Okay. So what happens is you go ahead and you say, when the second spouse goes to their reward, the charity gets the house. So that could be many years in the future. It could be 30 years from now, 50 years from now, whatever. But right now, today, year one, the year that you agreed to this. And again, physically, nothing changes. Physically, you and the spouse are living there the rest of your lives. But when the second of you passes, the house goes to the charity. In the year you make this agreement, physically, you're living there, nothing changes. The actuary comes in and says, okay, based on your ages, what you gave away, and I'm just making up a number for illustration, what you gave away is worth $800,000. What you kept is worth $200,000. So you get an $800,000 tax deduction. And if that is too much, well, I don't make $800,000 a year. It's too much. That's okay. You can carry it forward. So the bottom line is, it does what you want. You want to live in that house for the rest of your lives until the second spouse passes. But you wanted to give the charity something after the second spouse passed. Doing it this way, you get a giant tax deduction, which means during your lifetime, you get a giant tax deduction, which means you pay less tax. You have more money in your hand solely because you set up what you wanted to do anyway. Physically, everything's the same, but doing it this way, through the trust, you save a boatload of money in taxes. So you have more money all the rest of your lifetime.
I'm listening to this and I'm thinking what a lot of people think. All right. Here's a person such as yourself, and I don't know what you charge, how you charge, but most people would say, this is why the rich don't pay any taxes. They can hire someone like Steve, all right? And Steve can come up with all these things that most people, even plain CPAs. CPAs don't know all these rules, all right? So, here it is. If you have a lot of money, all right, you can hire people like yourself, all right, and save a lot of taxes. Well, what about people who don't have the resources to hire someone like you, all right? They're going to pay more taxes probably than the person you're dealing with. Am I correct?
So here's how I answer that. So many times when somebody says, well, what's it going to cost me? My response is oftentimes a fraction of your tax savings. So if I said to you, my fee is X, if you save many times X, it's worth it now, isn't it?
What kind of income, the people you're dealing with in your practice, what is their income? Do you have a figure? I mean,
Yeah, you know what?
who
You don't
comes
have to be
You're not
rich to
going to
deal
take
with it.
someone who makes 100,000 or less, are you?
Why don't we say middle income people?
Which
So
is, let's talk about, what are we talking about in middle income?
I would say, 100 on up.
100,000
Yeah.
up to
what happens is, much like a tailor, you fit the suit to the person. If somebody 6'8" and 300 pounds walks in the door, you build a different suit than somebody walks in that's 5'2" and 137 pounds. Still have a suit, they're just different suits. So what happens is we tailor it to the client. Suppose somebody is middle income, they have a business. You say, well, all right, you can have a pension plan. We can do cost seg, we can do R&D, and basically look at all the taxes we're saving, and the fees that we take are a fraction of that. So everybody's better off. And our Congress, in their infinite wisdom, says, hey, do these things. Again, think of the tax code. Everybody thinks of only part one, extraction of money. I'm dealing with part two, all the tax incentives. And again, that's why the government wants you to do these things. It's good for the economy. So everybody wins. You do something that's good and you get a tax benefit. And that's why I went to law school. When I started my career out, most guys that have a really heavy background like me start off with the big firms and the clients of the Fortune 500. That's how I started out too. That's what I was doing in New York before I came to San Francisco. And I always worked real hard. And I remember one night I was working away for this Fortune 500 client, and it dawned on me. I said, I could be the best guy or the worst guy in the world. It's not going to matter at all. If I don't show up, it's not going to matter to this Fortune 500 client. Do I want to spend the rest of my life giving everything I have, and it literally doesn't matter if I even show up? I said no. So I stayed with that firm long enough to get some good experience. And then I went out on my own. I remember one of my very first clients, very nice gentleman. He was upper middle age, not quite retirement age, but knocking on the door. And he had a little dispute with the IRS. And we had to go to court. And he had his aged mother and his sister, who was an accident lawyer, in the courtroom. And every 5 minutes, everybody was reminding me that if I lost this case, he would lose what he worked for in a lifetime. Now, that would make most guys nervous. For me, it was exhilarating. I said, this is why I left the giant firm with the Fortune 500, where nothing matters. To this guy, I am the most important person in the world right now. And when I got him off, he was thrilled. I was thrilled. That was many, many moons ago. But I still remember the guy. And to this very day, I still get the same visceral thrill when I say to a client, hey, look at all the money I save. For example, we had a client a couple of years ago, just before the pandemic, that came in. When he first came in to see me, he had terrible tax problems. And I set him up in a pension. And shortly thereafter, he says, Steve, he said that, his whole life he was struggling just to pay the taxes. Now I got him current on taxes, and he had $250,000 in his pension. And it didn't take him that long to get the $250,000. And he just was incredulous, because he said he was always struggling to try and barely pay the taxes. Now his taxes are all paid, and all of a sudden, this, to him, magical $250,000 showed up in his bank. So, these are the type of things we can do, and this can apply to people of all income levels. And, again, somebody that's making a lower amount, they still need the help, but maybe they need less help and a less of a fee than somebody that needs more help. And we deal with people from all walks of life. For example, we do some really fancy international tax work. Boy, can you save beaucoup in international. On the other hand, you know what? We have some people that are of modest means that have simple businesses. We save them money too. So again, like a medical doctor. A medical doctor wants to help everybody that walks into his or her office, regardless of whether you have a serious injury or a minor injury, or better yet, watching your health. It's kind of like their version of tax planning, health planning. So you don't have that heart attack and stroke. You do the planning and say, well, look, maybe those bacon sandwiches you eat with the salami and cheese isn't the best thing for you. And maybe you should eat some more fruit and vegetables and so on and so forth. That's fun, but that's what you're doing. This, we're talking about people's economic health. And that's a major part. And that is very, very wide ranging. And we can help an awful lot of people.
When people are coming up to retirement, let's say it's 60 years old, okay? I'm just curious, what do you find? I mean, how much in assets do they have? I mean, I've been told that people 60 years old, don't have very much assets and they want to retire. And because people think, well, gee, if this person's going to retire, they must have millions of dollars in the bank, investments. Right?
So really, retirement is not so much a function of age, it's a function of money, and people have different philosophies. Warren Buffett, that I do not represent, is around 90. He's still working. I doubt that he's working because he needs the money. And he just chastised one of his former employees who took an early retirement at the ridiculously young age of 103. Whereas other people,
103?
yeah, 103. Whereas other people, maybe an athlete, plans to retire in his early or mid 30s. It depends. And let's talk about some other things. Suppose we do something as simple as moving to Puerto Rico. We have Acts 20 and 22, which essentially, you're not paying any taxes legally. So let's talk about that for a minute. Here in California, ever since the pandemic, people have been leaving in droves because they say, well, wait a minute. Why should I have a tiny little expensive apartment in not such a great neighborhood for a lot of money, when for the same money, I can move to another state and I can buy a big, nice house? And a lot of states don't even have a state income tax, like Florida, Texas, the state of Washington, and other states too. And they say, well, I'll just move, because they put up with the high taxes here, 13.3%, because I make so much money at my job. And that was true when we all, up until the pandemic, every day I put on my blue suit and my white shirt and my tie, and I went to the financial district and I met with people and shook hands. And now, since the pandemic, I've been sitting in my living room doing exactly what I'm doing with you, talking to you on Zoom. Well, if that's the case, you can do that in California or any place else. That's why so many people have moved to Texas, Florida, and other places, Nevada. However, if you go to Puerto Rico and you only have to stay there half a year, you can legally avoid almost all the federal taxes. And say, well, why should there be such a law? And that's the law. And the benefit here is that some people have gone as far as giving up American citizenship. But in Puerto Rico, you get the best of all worlds. You don't have to give up American citizenship. You're still a good American citizen. You're living in a nice tropical area, but you're paying almost no taxes. So again, as far as planning, when we talk to a client, we say, well, how attached are you to the local area? And if somebody says, look, they will not leave the particular place they're in, okay. But a lot of people, especially since the pandemic, we've had droves of people leaving California, but they go to another state. Well, one of the things you can think, and there's other countries that have all kinds of tax treaties and, you know, et cetera. But Puerto Rico, you have the best of all worlds because you can still be an American citizen. And another thing is, people are hearing, oh, this guy Steve's in California. Boy, I sure wish he was local because they're hearing us all over the country. So let's talk about that because we do cases all over the world. For example, I was honored by the national government of South Korea when they had me address their National Congress on International Taxes. So suppose you live anywhere in the United States. What is the IRS definition of an attorney? The member of any state bar. So that means I could appear in Maryland or New York or Texas or Florida or Alaska or anywhere in the United States, and I'm recognized as an attorney, just the same as I do here in California. Yeah, but what if I have to go into tax court? You know, you certainly want the attorneys being familiar with the judges. There's only 19 presidentially appointed judges for all 50 states in the tax court. So that means that if we appeared before a judge in Maryland or Texas or Maine or Rhode Island, it would literally be the same judges we appear before in San Francisco. And the other thing is now with Zoom, so many clients here in San Francisco, nobody wants to come in the office anymore. Everybody wants to do Zoom. They want to stay home, you know, and you save all that commuting time. And it does make a difference. You know, there's like any major city, there's congestion. And people like being at home or like not having to leave their office. So it's really worldwide now. It doesn't matter where you are, especially if you're in the United States.
I'm going to jump to one thing, if you don't mind. We have a lot of individuals who listen to this.
Good.
And my first question is this. We're going to be filing the 2021 returns. Is that correct?
Mm-hmm. Yeah.
Now, individually. I'm talking about individually. Forget the business returns. What has really changed as far as people on their individual return? I mean, what items are the deductions they set up, the amounts of the deductions? Are there any major changes, all right, for the tax year 2021?
So everything is not just for business. Here's something that comes up all the time. People say, you know, all the tax advantages, especially since the Tax Cuts and Jobs Act, all the advantages for business and the individuals have less and less and less. But there's a lot of things that can be done. Suppose you're an investor and you can be an employee or you can be crypto or stocks and bonds, real estate, whatever. What we do for that person is set them up in an S corp for the investments and then put a pension in the S corp. So now, see, pensions are meant to offset business income, not investment income. But by doing it this way, you effectively are offsetting that, and it's a huge tax savings. Do I have to be an S corp to do that? No, you don't. But oftentimes it's advantageous and you get even more pension benefits with a corporation. And then we have the matter of, for those that are listening that have a state income tax, and most states do have an income tax. One of the things that the Tax Cuts and Jobs Act did was take away our ability to deduct our state income taxes paid in excess of $10,000. For some people in high tax states like New York, California, for a lot of people, that was their biggest tax deduction. So what's happened is almost half the states have enacted legislation as a workaround. For example, here in California, there's something called AB 150 that passed on July 16th of 21, which essentially, suppose you were a sole proprietor. Well, you paid all these state income taxes, too bad for anything over 10 grand. So with the AB 150, you do an election to pay the taxes at the corporate level, which still are deductible, getting a credit on the personal level. So in effect, you can deduct that. And again, it's not just for you California listeners. Almost half the states have enacted that. Now the Biden administration says, that 10 grand was pretty strict. Or our Congress people in their infinite wisdom are thinking about upping that from 10 to 80. But in the
Or which
meantime,
year is that going to be?
they were talking
Is that going to be retroactive?
as
No.
of this taping, they were talking about retroactive, but who knows what these Congress people will do. But anyway, if you're making more than that, depending on your state law, you might want to take a look at these things. So again, it's something that it's individualized, like a medical doctor. Everybody goes to the doctor and the doctor says, well, for you, you should do this. For you, it's okay if you do that. And for you, whatever you do, avoid that. So there are things that can be done.
But the state and local taxes for an individual for 2021 is still a maximum of 10,000, right?
Unless the Congress makes it retroactive, which they're thinking about doing.
What's the chance of that happening?
Who knows? You see what these people do. Who knows?
Do you see,
when I was a law professor, I told the students that there's a big difference between law and other things. Gravity is gravity. So gravity is the same whether you're in the United States, Russia, China, North Korea, South Korea, wherever. If you hold something up there and you let go of it, it'll fall to the ground because it's gravity. But law is only what those in power at the time say it is. So and things change. When you talk about it, our federal income taxes, as we know them today, started in March of 1913.
Mm-hmm.
And back then, the top tax rate was 6%, 6%. And in order to be in the 6% tax bracket, you had to be making over $500,000 in 1913 dollars. There's lots of people today in 2022 that don't make $500,000, and people were outraged at that time. So the bottom line is these things morph and they change, and that's why every day, what's the tax law today? Because it changes.
Is it harder to do tax planning today than ever before? Because things change. Seems to change.
The bottom line
more
is,
quickly.
I don't care how hard something is. That's what my job is. It's like if I go to the doctor and I have something he has to remove in a very difficult part of the body, I don't care how hard it is for him. That's his job. So again, this is my chosen profession. It doesn't matter how hard it is. To the best of my ability, I want to do everything I can for the clients, and it makes a huge difference. And that's why I don't deal with Fortune 500. That's why I deal with, forgive me, I'll call them real people, real business people that,
What are real business people? What type of, are you saying, you were talking about 100,000? What is the small business client who comes to you realistically? How much money do they earn? Can you tell me?
Yeah, I would basically say 100 grand on up.
100,000 or more, 100,000 or less?
Or 100 grand or more.
Okay.
And the bottom line is, these are real, to me, the Fortune 500, it's a fiction. I don't want to deal with them, and a Fortune 500 company is very unlikely to come to me. We're just not right for each other. But to me, a real business person, somebody that basically works their entire existence, and oftentimes all the money they have and they could borrow is in that business. Their lives ride on that business. And you have oftentimes a husband and wife and kids, and everybody's dependent on that business. And so goes the business, so goes their lives. They live it, eat it, breathe it. To me, that's a real business person, as opposed to Fortune 500. It's just, I don't look at it the same way, which is fine, because the Fortune 500 is not the clients I want to serve.
Do you get clients who say to you a decent amount that I can't afford you?
Look, nobody can solve everybody's problem, but when they do that, then I'll refer them to somebody to be right for them. If you have somebody, there's a shoe for everybody's foot. If somebody comes in and they're just And that happens. And especially because, here in California, because I'm a TV and radio commentator, I get a lot of inquiries come to the office. And suppose John Smith calls up and he's just not right for me. Say, John, we just can't handle that for you. Let me refer you to so-and-so, and we refer them.
Well, your knowledge is, I mean, to me, quite sophisticated. Do most CPAs or know what you know? I mean,
well, I certainly can't speak for all CPAs, but I will tell you for myself. Remember, I was an MBA CPA when I went to law school. I went to law school to become a tax attorney to learn things that I didn't know as a practicing CPA. So I'll speak for myself. When I went to law school and I became an attorney, it opened my eyes. And when I became an attorney, I was able to do a lot of things that I didn't know existed when I was a CPA. So that was my experience. And I would assume, and again, I had a solid background in accounting because I had a bachelor's and a master's degree in accounting. And I started out with a giant firm. So, I really did have a good tax background, but I learned all these things like anything else. I'm healthy, but I'm sure if I went to medical school, I would learn all types of things about my body that I don't know existed. But I chose to spend my professional life with this tax planning, and that's why I went into law school. It's the same way after I got my law degree and I became an attorney in New York before I came to California. I went on, I got my advanced law degree, specialization in tax. I learned even more about tax. And then I became a professor of tax. So the bottom line is I devoted my career to that. And I would sincerely hope, after devoting so many years of my life to this, I would hope that I know more than somebody that didn't. Just like anything, like a doctor. I expect a doctor to know way more about medicine than I do.
What did you want to be an accountant when you graduated college? I mean, when you were in college, did you want to be an accountant?
So when I was in college, I was a poor boy. What I wanted was a job.
I'm sorry. Yes, go ahead.
What I wanted was a job. And I knew I could get a job as an accountant. And a lot of other majors, it's nice that you took basket weaving, but there's not all that much employment for basket weaving. And I didn't want one of those degrees where after I got out of school, I had to learn to say, do you want fries with that? I knew that as an accountant, I could get a good job. And then when I got into it, I said, well, wait a minute, it's accountants and lawyers that are running a lot of the big companies.
Right.
And it made sense to me. So then I got into it and I said, and then I really, really, really got interested in tax. And I said, I found the home. This is what I want to do. And I always wanted to be the best at what I could be. For example, when I was in college, I went to college in the daytime and I drove a taxi cab at night. And you know what? I was one of the best cab drivers because I did a little research and I found out there's some things I could do to make more money than the guys did. Something really simple. I got a train schedule and the drivers used to line up to wait for a train to come in. But when you're not driving, you're wasting time. What I did was I got a train schedule and I looked for when there's two trains that came in very closely. I would just drive in for the second train and there was a station full of people waiting for a cab. I did that as a cabbie. This is my personality.
That's smart.
And as a tax lawyer, I would hope that I do things even more sophisticated than getting the train schedule and looking for that second train.
The number of people taking the CPA exam, I'm sure you're aware of it, is dropping tremendously. Okay. And the AICPA has a problem and they just don't know, this is my opinion. They don't know what to do about it. They can't, people just don't want to come out of accounting and go into public accounting and work themselves to death. Okay. So we have it's not my problem, honestly, but it's the AICPA's problem.
Well, and part of it, I think, is the portrayal of an accountant in the movies. They portray an accountant in a certain light. And I've always felt it was kind of offensive. It's in the same way a certain portrayal of librarians and other things. To me, this is a good and exciting career. I'm very blessed. I like doing what I'm doing. I get excited by this and it's great. And I think, but I know about it. And one of the things that when I was a professor, I'd always recommend to the students, I said, you know what? Before you make a decision of spending years in school and maybe your parents' money, and then years in a job, you don't want to do something you don't like to do. Go and talk to somebody that you respect in the profession. Go to his or her office and even take a job. For example, to give you some idea, one of the things I'm proud of in my office, a lot of people join the firm as clerks, assistants, and you know what? Then they went on and they become attorneys. So if you're working in you know what it's really like, and you say, hey, I've had a taste of it, I know what it's really like, and I don't want to be an assistant anymore. I want to be the attorney. I've had people that stay with me 20 and 25 years. I'm very proud of them. So that's one of the things that I would say. Don't base things on a TV or movie portrayal. Talk to somebody that you respect. Spend whatever time you can in the office, even if you get some type of summer job with them, whatever it is. If you're Xeroxing or a receptionist or a clerk, or just get a feel for the office, get a feel for what it's like with the clients. And that's, if the AICPA came to me for my advice and counsel, that's part of what I tell them.
Did you do auditing when you went into the CPA
Yes, I
firm?
did.
How'd you like that?
Wasn't my cup of tea. And I noticed the difference between the audit staff and the tax staff. With the clients, they always ran away from the auditors because the auditors come like, well, let me see, you're complying with this and you're doing that. Whereas the tax staff, they were always very cooperative. Hey, you can save me some money. So early on, I had that, hey, the tax guys, boy, clients really like them.
Yeah, I remember doing auditing, which I hated. And the first thing they would say when you walked in, when are you leaving?
Indeed.
Yeah, and I wanted to leave early myself because I didn't find that detail work as exciting. And I had a tax practice in Colorado for 6 years, and I used to enjoy that. I think taxes is interesting. It's like putting together a puzzle,
It's funny. I make so many radio appearances here, and my hosts are very gracious to me, but they laugh and say, this guy, Steve, he actually, honest to God, loves taxes. And they hear my voice. I get so excited on the radio or TV when I'm talking about it. It does. It excites me. I know what I can do, and I get really, animated and excited about it. That's me.
How many? What shows have you been on? Like, for example, you mentioned NBC. What have you been on NBC? I'm just curious.
So here in San Francisco, I was legal analyst with them for 10 years. And Fox, I was legal analyst 7 years. That's separate. That's not purchased out.
But it's fun to be on the radio, isn't it?
It's great fun. 30 years on the radio, and everybody knows I got a lot of ham in me. And I do a lot of these things live, so I'm not hiding. And I don't use a teleprompter. I know my stuff, and I don't have a script, and it's not taped, so you can't say, "Cut. Let's try that again." And I do a lot of stuff live, and it's great fun.
And now I see, God, you're actually able to work on a beach, okay? And you don't really need an office, correct? You just get those Zoom calls coming into you on the beach, correct?
Well, it's funny. Although today I'm in my living room in San Francisco, my phone is now within my laptop. So I literally could go anywhere in the world and work, and it wouldn't make a difference. If I was in China or on the moon, it wouldn't make a difference. And again, you're seeing my Zoom backdrop, but I could be sitting in a place like that. It just wouldn't matter.
Well, wherever you're Zooming from, it's beautiful. Is the weather always this nice, by the way?
It is nice in San Francisco. That's one of the many attractions living out here.
I've heard San Francisco is changing a little because of they do have a problem with the homeless. Is that true? Is that?
Like everything else, there, like any city in the world, there are some places that are better than others. But I focus on the positive, and there's an awful lot of very beautiful, nice places here in San Francisco. I'm happy.
I've always loved San Francisco to come visit it, And I
Well,
haven't been there.
next time you come, I'll buy you a nice meal.
Sounds good. Where's a good restaurant? Name a restaurant if you could.
Oh, there's lots and lots of restaurants, and because I deal with a lot of mine, I don't want to favor one over the other on the air.
When we come, we're tourists, so we probably don't pick the best. We follow what the hotel tells us, But no, San Francisco, you're very fortunate. It's a beautiful city.
Indeed.
And you don't have the cold that we have here. Tomorrow's
I
going to be
remember
high
the
of
cold
4
I remember the
degrees.
cold from New York. I don't miss that.
Yeah, well, you see, tomorrow's going to be about 4 degrees at night. I mean, that is, that's why when I, you were talking about California, the real estate, the area I would want to live in, the real estate is outrageous. It really is. But it's, it's getting outrageous here too.
Well, but it's an investment. So like anything else, you recover your money.
Well, we have a place we have a second home in Myrtle Beach, South Carolina. South Carolina is a nice place, but
I've been there.
I don't like the sun. I burn like crazy,
Stay in the shade.
Good point. I'm glad I had you on today to tell me
See that practical solutions.
That's why you're a tax attorney. Exactly.
Yeah.
Yeah.
Well,
Well,
thank you
Steve,
so much.
I wish, we could probably talk another hour, but then you get tired of sitting there on the beach. So anyway, I want to thank you very much. Is there anything you want to say, share with people?
I just like to say thank you for having me as a guest on your show.
Well, it was a real pleasure, and I think an honor to have you. We're very lucky to get certain people to do this, although I've been fortunate with the guests, and they tell me the ratings are good. I don't know what ratings they're talking about, but we try to bring on people like yourself who can share their knowledge, all right, in 45 minutes to an hour. And a lot of people do. We get letters, believe it or not, that thank you. Gee, I listen to your podcast when I'm driving home. And by the way, the number one city, I want to thank them again, Atlanta. Atlanta listens to us a lot.
Well, thanks to all of you, and I look forward to being invited back again sometime. Thanks so much.
Take care, Steve. And
Bye-bye.
happy, healthy New Year to you.
You too. Thanks. Bye-bye.
I want to thank Steve Moskowitz, what did I say, Moskowitz, for being on the show. And hey, tune in next week again. We have new guests every week. And, we're just very fortunate we get very good guests. So anyway, ladies and gentlemen, this is Phil Yaeger. And please, I urge you, please be kind to people, all right? Because people are not always kind to me or you, but it doesn't mean you can't be kind to them, all right? Take care, everyone. We'll see you again soon.